In this video, we're going to do a brief review of the major financial statements. While I'm sure none of this is new for you, I'm going to try to get you to start putting an emphasis on what the contents of the financial statements mean rather than just definitions. This way of thinking will be beneficial once we start working on the analysis of financial statements. Financial statements are just an organized pile of numbers, but in that pile of numbers is a story. And the key to analyzing financial statements is trying to put together and understand that story. The balance sheet, for example, it's going to tell us what things the company possesses and where do they get the money to buy them. The income statement, it's going to summarize how they performed this year. The cash flow statement is going to track how money moved in and out of the business. And the statement of stockholders' equity is going to show how the owners of the business were impacted by the events of the year. We can put all those together to try to piece together a cohesive story of what is going on with the business. Let's start with the balance sheet. The balance sheet tells us two things. What does the business have in their possession and how did they get it? It's a snapshot at a particular time. For example, we're going to look at the company on December 31st, 2019 and see what we have in our possession. Those are our assets. And for all of our assets, there must be a source for the money to purchase them. Those are going to be our liabilities and equity. At all times, this equation must balance because for everything we use money for, we have to be able to attach it to a source. We can look at your own personal balance sheet to try to visualize this better. Take a look at some of the stuff you have in your possession. You might have a car, a computer, a cell phone, maybe a savings account. These are all of your assets. How did you come into possession of those things? Well, you might have gotten a loan to buy the car. That would be a liability. Maybe you have a credit card and use that to buy a laptop. That's another liability. And maybe you have a part-time job and you use your earnings to buy the phone and fund the savings account. That would be equity. So that's the basic idea behind the balance sheet. We're just keeping track of what we have and how we got it. A simple corporation's balance sheet is structured like this. Assets and liabilities are listed in order of their liquidity, with the most liquid items listed first and the least liquid items at the end. Liquidity represents how quickly and easily something can be converted into cash. The most liquid items, ones we expect to be converted into cash within 1 year, are called the current accounts. We have current assets and current liabilities. On the asset side, cash is listed first because it is the most liquid. How quickly can we turn cash into cash? Instantly, it's already cash. Typically, accounts receivable comes next. Accounts receivable is just the money owed to the company for sales made to customers on credit. These things aren't cash yet, but we expect to receive cash from customers sometime in the near future. Usually, inventory follows next, and inventory is the stuff we expect to sell and turn to cash in the near future. Following those liquid assets on the balance sheet are long-term assets, like factories, equipment, vehicles. These assets aren't very liquid. If we needed to turn a factory into cash today, we would probably have a hard time doing it, and likely we wouldn't be able to get a fair value. So these long-term assets are very illiquid. We have the same structure on the liabilities and equity side of the balance sheet. At the top are things like accrued wages and taxes. These are our most liquid liabilities. We're going to have to pay these items off with cash sometime in the near future. Following that is accounts payable and short-term debt like notes payable. Then comes long-term debt. Again, notice everything is ordered in terms of its liquidity. How soon will we have to pay these things back off with cash? Following long-term debt is the equity section. How liquid is equity? Well, it's very illiquid. That's why it's at the bottom. Remember, equity represents ownership, and equity does not need to be repaid. Here's a very simple balance sheet to glance at. One thing I want to make sure that you take in is the fact that at all times, the balance sheet must balance. In 2018 here, we had $1,680 of total assets. And alongside that, we had $1,680 of total liabilities and equity. And the same balancing act occurs in 2019. If for some reason it doesn't balance, we have a big problem. That means something wasn't accounted for. Our next financial statement is the income statement. The income statement is pretty simple. It just summarizes our sales, expenses, and profits over some period of time, typically over a quarter or over a year. The very top line of the income statement is going to be revenue. This is the value of what we sold over the period. From revenue, we begin to subtract all of our expenses. We take out our cost of goods sold, our administrative expenses, depreciation, interest, taxes. Once we remove every expense, we're left with our bottom line, our net income. As we go down the lines of the income statement, it's useful to refer to different checkpoints, which I've highlighted here in green. For example, the first level of subtraction, revenue minus cost of goods sold, is commonly called gross profit. If we further take out administrative expenses and depreciation, we can call that operating income, or EBIT, earnings before interest and taxes. These checkpoints will become handy because it's going to allow us to isolate or focus on a particular aspect of the business's performance. Again, here's a sample income statement to glance at. We start at the top with revenue, or sales as this company chooses to call it, and line by line, we deduct various expenses until we reach the bottom line, net income. Simple enough. Our next statement is the cash flow statement, and I think it's pretty interesting. Cash is considered the lifeblood of any business, so keeping track of how actual cash is moving in and out of the business is very important, and that's what the cash flow statement does. We're going to look at different activities of their business, their operating activities, their investing activities, and their financing activities to see what their impacts are going to be on our cash position. The cash flow statement can be summarized by the following identity. The sum of the cash flows for each activity will equal the change in our overall cash position. Let's take a look at a simple cash flow statement to get a better feel for what goes into it. At the top, we summarize the cash that went in and out of the business from their operating activities. We start with net income and immediately add back depreciation expenses. Why add back depreciation expenses? Well, you may remember that depreciation is a non-cash expense. And since this is the cash flow statement, we only want to focus on the cash impacts. So depreciation must be added back. Next, we have inventory. If our inventory increases over the year, that means we must have spent some cash to do that. So an increase in inventory has a negative impact on our cash. The impacts of accounts receivable, accounts payable, and accrued wages on cash are a little tricky to explain here, so I'm going to leave that for the recitation session to get into the details on those. As we skip down to the investing activities, we see that additions to property, plant, and equipment result in a negative cash flow. Cash comes out of the business to buy new equipment. And finally, we get to the financing activities. An increase in bonds means that we are borrowing more money, and borrowing more money means more cash is coming into the business. Conversely, dividends to stockholders are paid with cash, so that's cash leaving the business, a negative number. Section 4 here aggregates and summarizes all of the activities. If we add up the net cash provided from each of these activities, we can see that overall we had $70 million of cash leave the business over the year. And if we started the year with $80 million in cash, that means there's only $10 million remaining. Since cash is the lifeblood of any business, a careful analysis of the cash flow statement can give insights on potential trouble spots on the horizon. The final statement I want to mention is a statement of shareholders' equity. This statement details the position of the owners of the company. How much have they put into the business overall, and how much is the business paying them in dividends this current period? Let's break down this sample statement. On the top line, we can see how much stockholders have put into the business as of December 2018. As of December 2018, they've purchased 75 million shares of stock in the company, and as a result, contributed $130 million to the company. In addition, we have the retained earnings. The retained earnings belong to the shareholders as well. Remember, as the owner of the firm, the profits of the company belong to you. The company can either pay out the profits to you in the form of a dividend check, or they can reinvest the profits back into the business for you. That would be retained earnings. So the money that is reinvested belongs to the shareholders too. Putting the stock and retained earnings together, we have total shareholders' equity in 2018. Next, we want to see what the events of this year, 2019, will have on shareholders. Well, in 2019, they had profits of $146 million. And of that $146 million, $86 million was paid out to the shareholders as dividends, leaving $60 million to be retained and reinvested back in the business. So on the bottom, we show the current position of the shareholders. One last thing I want to emphasize is the interconnectedness of the financial statements. Because of the double entry system of accounting we use, you cannot change one thing without it affecting something else. For example, let's imagine something like a net income change. You might think, net income just shows up on the income statement, so that's all I have to worry about. And you'd be incorrect. A change in net income will be reflected on the balance sheet too because it's tied to retained earnings. A change in net income would also affect the statement of cash flow since it's the very top line of that statement. So while you're looking at financial statements, and especially while you're compiling your own financial statements, make sure to keep this interconnectivity inside your mind.